And welcome to another edition of the Nerdy Agent Podcast. I'm your host, Luke Pedersen, with my brothers and fellow nerds here. Today, it's going to get especially nerdy, I think, from what I've been hearing from the two nerds on my left and right.
If it gets too nerdy ever, you can leave us feedback comments.
Yeah.
If you don't want to hear about that level of nerdiness,
we kind of have to. With the name of the podcast, we kind of have to just sprinkle it in here every once in a while. Today we're going to talk about the new tax bill, as well as the credit rating news that came out about the United States. So to start, I think we're going to hit on the credit rating.
Sure.
Can you explain, let's say I'm just a random person, realtor that saw something about the United States, credit rating. Like, what does that mean at a high level?
But if you had the option to be an AAA or an AA1,
which would you be?
Which would you select?
All I know is that in my Gmail or in my Dropbox, if it said AA1, I think it'd be at the top.
That's a great question.
One is in front of A, I believe.
Well, maybe we should talk about Dropbox folders at some point.
Yeah, right. One was my jersey number, so I kind of think like AA1's kind of sweet, but that was a downgrade this week.
Too far in advance.
So can I
explain high level?
Let me just jump in real quick.
Explain the credit ratings high level.
So, and even why this is important, right? Because I think people
they don't know what it is first.
No, but like, why is it important that we talk about credit ratings of the U.S. government debt? Why is it important that we talk about new tax bills, right? Because real estate agents are going, well, this is not real estate related. It's important because a lot of this has been impacting both the stock market and the 10-year Treasury yields. And we've talked about in the past how that always flows through to mortgage rates. So as we're talking about why are mortgage rates moving up or down, and why is the Fed maybe going to do something different than what we expected, these are things that are causing those types of behaviors. So that's why we wanted to make sure this was a topic of conversation today, because when the credit rating thing happened, the 10-year Treasury yields and the 30-year Treasury yields spiked pretty fast and mortgage rates followed. And then now with this debt impact of the new tax bill, there's some impacts going on within the markets that are going to roll through to interest rates. So it's important that you know what they are and can talk about them with your clients. And they're like, why did interest rates go up? This is an important topic of conversation there.
So from a high level, explain what credit rating is.
So there's an agency called Moody's.
There's multiple agencies, but yeah, Moody's is one of them.
Big one. And they will say it's essentially like a I don't know, what would you call it, like a social credit score for large things like this? I mean,
yeah, they're essentially just watching everything and saying how confident are they that these
countries?
Well, they do it for a lot of different things, but these different debt sources going to be able to repay.
Yep. So like the United States government, as everybody knows, is paying lots of interest on all of the debt that we have through many different vehicles. And so Moody's is saying, hey, instead of you being AAA, AAA rated, which is the very top ranking, I believe there's more than 10 levels of this. They changed the United States last week to AA1, which is one step down. What we joked about was kind of funny as the market reacted like crazy. Started trading like this wouldn't be, that the United States is all of a sudden a lesser thing, when most of the information that Moody's came out with and the data sources that they were using were actually things we already knew. There wasn't really any new information other than them giving their opinion.
Correct. Yeah, and I think other agencies had already put the United States government bonds in the second tier. So it was just, the reaction was kind of, I found surprising, because it wasn't like anything meaningful had happened differently. We already kind of knew what was going on in terms of the level of debt. But at a high level, the way that they looked at it was saying, hey, we've continued to add debt to the national ledger. So therefore, we are getting a little bit more concerned that as the debt continues to grow and there's no sign of it slowing, that the ability to repay the debt becomes more problematic.
And we would be the largest country probably in the world that was AAA rated before this. Like Canada and Germany and Australia are all AAA. The rest of these countries are really small.
Oh, thank goodness I got all those
like
Australian muni bonds.
Luxembourg. So it lowered it from the highest rating to now the second tier.
Yep, which spiked the 10-year Treasury yield. So,
why?
Why? Well,
that one I don't really get that much, though. It spiked it. But technically, wouldn't there be less buyers of those bonds if...
Explain the
yeah, so then
background to
there's
that
less
so they
buyers, so the
understand.
price goes up because, or the returns go up.
Yeah.
Okay.
So why did it spike?
So at a high level, now I'm like in my head, I'm like, did I get this right? The 10-year Treasury bonds are impacted by the amount of people that are buying and selling those bonds. And so when this declined, people said, well, this bond is less valuable now
Because the bond is from the United States.
and the risk of them paying it has been said now that it's higher, right? So I need to get a higher return on this asset because the risk of it is higher now than it was yesterday. And so then people fled, and the price that then you had to get in terms of your return on those bonds went up in order to satisfy the reality that this credit rating change now created.
All of the investors stopped buying the bonds from the United States and they started buying the Luxembourg bonds.
Or something like that, or they fled to something else. But it essentially, yeah, I'm guessing it was more like the reality, right? Was we already kind of knew the information. But what happens is when something like this changes, it creates momentum, which then creates behavior, which then creates changes in the marketplace, which then trickles through all the way down to mortgage rates.
Do you think that that's going to be a long-term, they're going to continue to feel this way about it? Or do you think it's going to be more so the news came out, this adjustment happens, and then it goes back to normal?
I mean, that's a good segue into the second topic we wanted to talk about, probably.
The tax bill.
Yeah.
So...
Because it was basically like a one-day pretty heavy blip.
It was a one-day pretty
And then
heavy
it dropped down after that. So we went all the way up on the 10-year to 459. Yeah, it jumped up and then it's come down a little bit since
But
then.
then it jumped back up again after the tax news.
Now
came
it's up
out.
again. Yeah.
So yeah, I mean the tax bill layered on top of that, Luke, is
So
very
high
interesting.
level, they're working on a new tax
Well,
bill?
yeah. So think about this. You've got all this debt we have, and now this Moody's agency is saying this debt's in a little more danger than it was yesterday, right? Well, what happens now if you add more debt to that debt? It probably doesn't look very good, right?
No.
And so the Republicans are wanting to pass basically a tax cut extension, most of it, which extends the tax cuts they made in Trump's first term. And then they want to include a lot of other different features that could, in the opinion of the market and investors, lead to further inflation and further problems within the economy. Because the more money you give back to people, the more money they have to spend, and the more that these kinds of problems can persist. And so you layer that on top of tariffs as well, which we've talked about before, right? So you're looking at all these different things and you're going, the debt seems it's not as good as it was, and the spending may increase because the government's bringing in less, which is making that debt worse, but it's also improving the incomes or the realized incomes of the citizens, who are then going to go out and potentially spend more. More demand leads to more inflation. So everything's kind of pushing those yields in one direction.
Yep. And the national debt right now is at 36 trillion. So just to give you a reference of where we're at, we're over 36 trillion. We're paying interest on all of that. So that's part of this as well. And the new tax bill, the studies on it have said it will add 3 trillion to the national debt. So now we're pushing upwards into the 40 trillion range, right? We haven't had, we can fact check this, but we haven't had an actual surplus in terms of tax revenue versus amount of spending at the government level since the Clinton administration. So every administration after the fact has been spending more money than they've been bringing in from a tax standpoint. And so now, I think when the new administration came in, there was a lot of talk about, when Doge was talked about and all these things, it was like, we're going to cut and cut and cut and cut in order to ensure the government is run more like a business. Well, that, who knows what's actually going to happen in terms of any realized savings there, but the actual impact in terms of the national debt has still been to add more debt. So even if they're pulling back on some expenses, they're still spending more than they're bringing in from a revenue standpoint. So it is, continues to be something that I think is concerning to a lot of people, and will play out in terms of just looking at where, market rates and behaviors will go.
Do we think that tax bill, as is currently, is going to get passed?
So it passed the House by 1 vote.
Oh, it did. Okay.
It was very close, but now it's to the Senate. They've said that the Senate is likely going to change it. So it's kind of funny because, we react to what if this happens, but if the Senate's going to change it, then if the Senate changes it, then it has to go back to the House. So it's going to go back and forth. The debt ceiling date, I think, is in August. So they have to get something done by then, or else they're going to bump up against that debt ceiling, and then everyone freaks out for 3 days.
The government's going to shut down.
Yeah, I mean, it's like the number of times this has happened in the last 10 years is remarkable.
So it's going to go back and forth between the Senate and the House until the last day on August, and then they're going to agree.
I mean, we'll see what happens. I hope not, because it's always annoying when those headlines come up. It's like, the government's going to shut down. The government's going to shut down, and everyone
freaks out.
Well, each party is pushing the other party into the fault lines, and I don't like to get into politics.
I think Trump wants to get it done by July 4th for celebration's sake. That's what he said, I believe. The other thing that's interesting, though, it's really cool that if you're an agent out there, our PAC is the Realtor Political Action Committee that operates out of Washington, D.C., and when you get the chance to renew your license, you don't have to, voluntarily give them a donation, but I would suggest you do. They've done a lot of really cool things over the years. And what happens on a lot of these large bills is there's thousands and thousands of amendments, and there's all these political action, different groups and committees like ours that is coming in and saying, hey, include this, and they're in the ear of all these congressmen and women. And like, they got enhancements to the low-income housing tax credit. They got estate tax certainty and renewed opportunity zone incentives, and the creation of a tax-advantaged child investment account that can be used for qualified expenses of the beneficiary, such as first-time home purchases. So, cool. Our committee goes in there and they get stuff put into these bills that may or may not even really relate to the taxes that they're, that are headlining the bill. But they are things that are going to impact people in the real estate realm. And so I think it's pretty cool to see them still obviously involved in that.
As far as the impact on with the taxes, with the credit rating, you guys were talking about the Fed as well. Mm-hmm. Tell me what
they're in a tough position, because the Fed, as they make decisions, that obviously trickles through to interest rates. The higher the interest rates, the more of an impact that has on the national debt. Because if interest rates are high, you're borrowing at higher rates, right? So they can have a harder time justifying keeping rates high when the debt is high, because that creates more pressure on that national debt number, which will create pressure on that economy. Because, people have been saying it forever, but at some point that debt becomes more of a problem for the global economy as well as our local economy. And on the flip side of that, though, to AJ's point, that with the tariff component potentially creating some pressure on inflation, and now this bill, theoretically, if it reduces taxes, now who it reduces taxes for is a different conversation, but if theoretically it reduces taxes, that puts more money in the hands of people who are spending money. So if people have more money to spend, they usually will spend it, which will also impact inflation too. So the Fed might be looking at this going, well, we have one side of this, which is going, if rates stay stubbornly high, that is going to hurt the national debt in perpetuity. But if we bring rates down at a time where we also have tariffs, at a time where we also have tax credits essentially, or cuts, we're going to have more spending, which is going to increase inflation more rapidly and is going to offset all of the work that we've done over the last 3 years to kind of get inflation back in check. So they're in a tough spot right now. I think what they will do, if I've seen anything from them, it's been they will tread very carefully, and they will probably be very conservative in terms of taking a stand. So my hunch is they'll probably sit still rather than like rock the boat with an increase or a decrease. But at some point, they're going to have to make some sort of a decision to kind of work within this. Else.
You said the secondary market, though, is potentially banking in an increase.
No, I think the bond market is. It seems like the secondary market on mortgages has been kind of interesting, because we've seen a little bit of compression on that 10-year versus 30-year fixed mortgage rate. Because we got the 10-year went over 4.6 yesterday, and I think the Mortgage News Daily's got us at like 7.07.
08, yeah.
Yeah, so we'd be, roughly 15 basis points off of that 260 number that we were seeing before. Obviously, it's nice to see that we're moving away from the 300 basis point spread we had during the pandemic, or right after the rates started going up after the pandemic. So seeing that to continue to kind of erode would be super nice, because then we'd be a little bit more independent of these high bond yields.
To wrap up here, I want to know, what can I say to one of my clients weaving this in?
Oh, script of the week.
We're
back to it.
Well, because that was pretty nerdy. And it does make sense. And if you need to listen to this one again, maybe just listen to it again. But if I had to take one tidbit, and it was like, I'm talking to somebody at a first buyer meeting. They're like, man, I thought the interest rates were going to the 30-year interest rate was going to be lower. You know, everybody was talking about how it was going to be, low sixes at this point. It's still 7. What's going on?
A lot of things are going on right now that are causing the market to be a little bit volatile. And you got to realize that mortgage rates are completely determined by a pool of investors that's investing in these kinds of products. And so when you look on the news every day and you see something crazy happening, the investors that are influencing these mortgage rates are seeing the same thing. So you see tariffs, you see tax cuts, you see all these things. They're going to move the market.
See the credit rating going
right.
worse.
You're going to see the market move one way or another. So just keep an eye on the news. But again, like we always talk about, if you're a buyer, be prepared to buy the house that makes sense for you right now. And if the rate goes up, then maybe you do have to decrease your price a little bit in order to get into something that you want. But just be prepared, because it only takes one house when you're a buyer. When you're a seller, the game is quite a bit different. But as a buyer, it just takes one house, so just be ready.
Yeah, I'd add to that, like, uncertainty creates fear, and fear creates swings in the way that things are kind of operating. And so right now, there is a lot of uncertainty in terms of impacts of some of the things that have been put into place. And now we've added some other components to it outside of just the tariff stuff that had already created a lot of uncertainty. So I tell everyone I work with right now, like, don't expect any massive shifts in interest rates downward, right? Because everyone's like, we're going to get decreases in interest rates. Like, don't expect that right now, because there's too much uncertainty in terms of how everything's going to play out for that likely to happen in the short term. But to AJ's point, just be cognizant of whether or not at this situation, at this time, the house, the price, the monthly payment works for you. If it does, you can lock it in for 30 years. And then if things change, you have flexibility, but just go into it not expecting things to change, because we really don't know if they're going to get better. But if they do, you have flexibility. So you always want to find a way to build as much flexibility into your life as possible.
And that's all we have this week on the Nerdy Agent Podcast. And as always, remember, be better,